That's one thing that's always been super important to me, because like the opposite side of that spectrum is where you feel restricted and you feel entrapped in like some sort of self-imposed slavery because you're trying to, max out your lifestyle, but you've really minimized your freedom at the same time. So it's this weird conundrum that people get into. They think they're gaining something, but they've forgotten what they're losing in the process.
The Aussie Fire podcast is a collaboration between Strong Money Australia and Pearler, Australia's favourite boring long-term investing platform. Join our hosts, Dave from Strong Money Australia and Hayden from Pearler, as they discuss all things financial independence. At Aussie Fire, we're big fans of sharing experiences and talking about money. However, please note that any advice is general and does not consider your financial situation, needs, or objectives. Consider whether it's appropriate for you, and if in doubt, speak to a licensed financial advisor. Hi everyone, welcome back to the Aussie Fire Pod. We've got a really exciting episode for you today. We have another case study with one of our listeners who's joining us to share some of their story and some questions they have to help them on the path of financial independence. Because this is an episode where we do bring another guest onto the show and we do talk about their circumstances, it's important that we do give a quick disclaimer at the start just to make sure that people are aware about the degree to which this is not personal financial advice. So everything that we cover in this episode is general information only. That basically means everything you hear from ourselves and from the guest, it does not cover your personal circumstances, your objectives, your financial situations or needs. As we always say, we don't know you, we don't know who you are. In fact, we barely know the guest today, and we're only going to learn so much in 10 or 15 minutes. So for that reason, it's important that anything you hear today, before you act on it, you remember that it's general and you do go seek a trusted professional for any advice you might want, like a financial planner, an accountant, or something like that. Due to some last minute changes of plans, we were originally going to get Steve in at a desk today, but he's had to call in on his phone, mostly just due to the circumstances. So there may be the occasional audio quality issue today, something that might be hard to hear. And obviously we don't have any video for Steve for those of you who are tuning in on something like YouTube. So thanks for your understanding there. We're hoping that it's the content that carries the conversation and not the quality of the video or the audio, but we'll continue to do our best to improve that as we go. But regardless, we're really excited to welcome Steve onto the podcast today. How are you doing, Steve?
Yeah, good. Thank you, guys. Thank you so much for having me. Big fan of the podcast, so it's exciting to be on.
No, thanks for coming on, man. We always appreciate when people are willing to come on and share their story and share some, personal details, and, hope to answer your questions fully today. And hopefully we can help you in the decision that you're kind of battling with at the moment.
Thank you.
Right, so let's just run through a few of your details here, Steve, and maybe you can update us as we go along too, because you sent this case study through at least a few months ago, I think. So some of those things might have changed. So we're more than happy to have the updated figures and updated situation if we need to. So as I kind of go through it, please feel free to jump in and correct me if anything's changed. So you're in your late 20s, you are in a relationship, and from the case study, it looks like you're planning to factor kids into your situation in a few years' time or something like that. So on the income side of things, you're telling me that you're self-employed and you're a sports coach and you earn roughly 120 to 130,000 per year, and your partner earns 100,000 per year. Is that before or after tax?
These are both before tax.
Before tax, cool. And on the spending side of things, you've got household spending of 50 to 60,000. You've got a mortgage which costs you 25,000 per year. You've got business expenses which you've noted as 20,000 per year. Travel as $20,000 per year, which you said you value a lot as you have family overseas, but it's not a necessity. And you invest into ETFs in the range of $50,000 per year, which is pretty significant. So well done for that. And the remainder is kept in like a business/emergency savings account, just because of the fact that you're self-employed. So there's obviously some lumpiness of income and some extra costs and risks associated with that. So it's a pretty good overall monthly picture in terms of your cash flow and how much you're able to save and allocate to investment. So that looks pretty good. So is that still all roughly up to date, or has anything changed there, would you say?
No, that sounds about right. I would say, given I'm self-employed, there is a lot of flexibility and changing in work hours. And obviously the income can be fairly variable. So they're still rough figures. And I've sort of tried to even that out across the last couple of years, which have been pretty consistent.
Yeah, sure. Yeah, I can imagine it would be all over the place sometimes. So that's definitely something I can appreciate. On the assets and investment side, we've got an apartment that's worth, you've noted it's between 550,000 and 575,000. Do you think that's still probably accurate?
Yeah, I mean, based off the sort of realestate.com valuations, it's roughly at sort of 570 at the moment. And I purchased for 550. So there's not a lot of growth there, which I acknowledge with a 1-bed, 1-bath wasn't going to be the case too much. And property is not probably a massive factor in my financial journey in terms of where I want to get to. It's more a security sort of side of things.
Yeah, sure. We've also got ETFs of 200,000, which is pretty good. And there's crypto also of 20,000. And then on the debt side relating to your property, it looks like there's a home loan of 340,000, which is a bank home loan. And then you've also got another aspect here, which is 120,000, which is through the Victorian Home Buyer Fund, which is essentially is that like a help to own type setup where they own some of the equity?
Correct. So I actually went back and did the exact figures. So the loan originally was 360 and it's now down to about 345 from the bank, that is. And then I purchased through the VHF, the Victorian Home Buyers Fund. So yeah, that exact figure was actually 135,000, but that's based off a calculation of roughly 25%, which is what the government can obviously put up. So that would be with a new valuation, which you do through the scheme, obviously adjust to updated property value.
Yeah, okay. So that's quite interesting because there is different schemes like that in different states. I know we've got one here in WA that works in a similar way. But one thing I didn't know, which you put down in your case study, which I found was super interesting, is that this loan is actually interest-free. So you've essentially, the government will fund, say, 25% or 15% or something of the property, and then you slowly pay them back over time and not have to pay interest at all on that money. Is that correct?
That's correct. So it's interest-free. The repayments, and that's sort of part of my question to you guys today and to get your thoughts on it. I've got an option of either you go and get a valuation and pay off the entire amount, or you can do them in installments of a minimum of 5%. So the maximum amount of repayments you can do is actually 5 repayments over that time. Okay.
So when you say you refinance it, what does that mean exactly? You have to pay them out in full by refinancing to another bank or in cash? Is that one of your options?
No, not refinance. So I go and get a valuation for the property. And then based on that valuation, I have to pay back the 25% that the government holds.
Okay, sure.
Yeah. But that could be in one lump sum and just pay back the 25% based on that current valuation. Or it could be, I could choose to do it in lump payments.
Does the government always hold 25% or is it like a fixed dollar amount?
It's a percentage amount. So in this case, it's just under 25% for me.
Right. So unlike a bank, it's not like security. It's like they actually got the equity in the home.
Correct.
Yeah. Okay. Sure. Oh, so that's interesting. So as the home price goes up, even though it's interest free, you have a larger amount you have to pay back the government, basically.
Correct. And I mean, the benefit from my point of view when I was purchasing, obviously, as a self-employed person, it was a little bit more difficult getting loans at the time. And then obviously that interest-free amount. Additionally to that, I didn't have to pay LMI or stamp duty as well. So there's the benefits of those upfront savings.
Yeah.
So that probably brings us to like the crux of your case study and what we're going to talk about today. So do you want to just run us through briefly your situation, or in detail would be good too, and exactly what you're kind of tossing up between and the different options that you're considering and what you'd like our thoughts on exactly?
Absolutely. My partner's recently moved into the property a few months ago. So we're currently here. I purchased it about 2.5 years ago. And we are planning to have kids, I would say, in the next 3 or 4 years. And like I mentioned, it's a 1-bed, 1-bath. I love the property and I've loved the location and it's been fantastic for lifestyle. But with that in mind, I know when it comes to having kids, we'll need a bigger place. And naturally, it's sort of that next progression where I'll need to move into something a bit bigger. So sort of my situation, and to get your thoughts on how I would repay that government amount, because I guess the added information there is I actually can't put my name on any other property until I've paid off that government portion as well. So for me to go and rent or buy, I have to pay off that outstanding 25% amount, yeah.
So is it an element where you kind of, it's this like slight feeling of nearly feeling trapped, right? Because you can obviously, if you can't pay that off straight away, you're basically caught between staying there or selling it, essentially, right?
Correct. That's exactly it. Yep.
Yeah. And this is then ties into the ETFs, because you've obviously got this pile of ETFs over here that can solve your problem, but that feels really rough to go and like kind of empty that out when you've been like saving that up over time and investing, right?
Exactly right. Yeah. Like in the context of sort of my goals and what I have planned for the future, the ETFs is a big part. I'm not huge on property. It's never been a massive part of my plans. This property was bought probably more with lifestyle in mind. And then I've had that ETF portfolio to really grow and try and get some more financial independence.
Yeah. If I could ask a question, if you sold your property now, you said that the value of it's gone up by $20,000, $550 to $570. You obviously paid some conveyances or things like that. Like what are you down if you sold it now compared to when you bought it? Are you down at all, or is it pretty break even? Because I assume you didn't pay stamp duty in Victoria for that scheme too, right?
Yeah, correct. There were a lot of savings like that where I didn't have to pay LMI or stamp duty. So I would come out probably break even with the jump in price if it was sold for that sort of 570 mark, maybe even making a little bit. Yep.
Is there absolutely no way that you can refinance this loan to a different bank and then that basically pays out the Victorian government from their equity share and get a new 80% loan from a different bank? Is that not possible with this particular scheme? Because you're at roughly 80% LVR now, which most banks would be happy to take on.
Yeah, so my understanding is the scheme you can refinance in that context. It's not something I've explored a heap, but that is definitely an option down the track.
Because that's probably something I'd look at immediately though, because then that lets you keep your ETFs untouched. It also lets you not have to put your monthly savings towards that loan, because if you could refinance basically in the next 6 months or so to an 80% loan with another bank.
The refinancing amount I have at, even based with what I've paid down a little bit, would still leave it over the 80% though, borrowing, because the loan initially I was borrowing effectively between the government and the bank. I was borrowing 90% of the price. So I'm still, with the jump in property price, I'd be close to the 80, but I probably wouldn't be there yet.
It would probably only be like a couple of tens of thousands off though, right? Because the total debt's like 460. Yeah. So you'd only need the loan to be maybe 440 or something for it to be 80% LVR, which is not very much. You could probably have that paid down within like the next 6 months and refinance to another bank.
Correct. Yeah, that's definitely an opportunity as far as I'm aware through the scheme that I could refinance that way. Yeah. Because
that, to me, that's more appealing than selling ETFs. But on the other hand, I'd also want to know from you, how soon do you want to move out of this place and into a bigger place? Or are you happy to wait until you've got kids on the cards and kids coming to plan for? Because having this interest-free loan is like a huge free kick, really. Like it's very, very handy. So I'd be tempted to try and string along that interest-free loan for as long as possible.
Yeah, I was going to say I'd wait as late as I could. Yeah, probably to the point where we're having kids. I think we love it here at the moment and it's been fantastic for that lifestyle. So it would probably still be, I'm definitely preempting all of these things, and that's sort of the way I am. I prefer to plan for these things and just make sure, like Hayden was saying, I'm not sort of that feeling of stuck in the property and don't have options. So it would probably be still 2 or 3 years away until we'd have to move, in my view.
Yeah. And then in your case study, I think you wrote that you're quite open to rent vesting as well. So I guess one another idea would be that you potentially just leave the loan as is and you don't refinance and you keep paying the minimum and you stay there until you need a bigger place, and then that place just becomes an investment property, and then you rent a more suitable size home for yourself, if that would work. Because then that lets you keep the ETFs, keep the property, which you said you're quite attached to, you love the property and you wouldn't mind keeping it as a long-term rental, and then also lets you have a proper size family home for yourself when you have kids and that. But I suppose a related question to that is, most people don't like the idea of renting when they have kids. How do you feel about that?
I'm more than comfortable with it. In my view, that's what I would like to do. I'd like to end up investing and hold on to this property. The only sort of side note to that, again, is to put my name on that rental. I would have had to pay off or refinance and have that government amount paid off. so I couldn't go and rent. Yeah.
Yeah. So you could, again, string that along for the next, like, say 3 years or something and enjoy the interest-free loan, keep investing as much as possible or building or you wouldn't need a deposit for the next place if you're going to be renting. But yeah, that would let you max out investments, not worry too much about paying off the home buyer loan, because then you could just refinance at the end of the 3-year period, because then you've kind of strung it along for as long as you could. And then you can start like renting a more suitable family home, if that makes sense. Hayden, do you see it in a similar way to me? I can imagine, I know you're kind of an optimizer brain type person, so I'm imagining that you would try and string along that interest-free loan for as long as possible as well.
Yeah, I mean, I find buying a place to live in is really interesting because you're making lifestyle and capital decisions at the same time, and they make them really complicated, because, like you can like where you live from a lifestyle perspective, but then you got to ask yourself, is this the best place to get a return on my money? But the government scheme makes it really unique in my view because, the way I think about it is you put $50,000 down, right? Roughly to the 10%.
Yeah, correct. Yep.
Yeah. So it's like, if you put that $50,000 in ETFs, so let's assume that ETFs grow something like, 12% per annum, something crazy, like a really good outcome. 12% per annum on 50,000 is going to be about $6,000 a year, right? And, that's obviously before tax. But, the fact that you've only had to put $50,000 in to essentially hold on to a, $550,000 asset, or if I correct it for the fact that you only own 3/4 of it, a $412,000 asset is the right way of thinking about it, right? Because that's like 3/4 of it.
Yep.
Something ballpark like that. That means that for that $6,000 ETF increase, you only really have to hope that your property goes up, as far as I can tell, by about 1% a year, unless I've cooked that math. And even like 1-bedroom apartments in major cities, as awful as they are for property growth, it's like, what are the odds that that's going to go from 570 to 585 in 3 years, And probably assuming you think there's forward movement in the market, that's not an absurd ask right now. I want to point out, obviously, like markets go flat for a long time, markets go down, but it just doesn't seem to me like it's a bad place to keep your capital. That would be my like, not saying it's good, but it definitely doesn't seem like a terrible place to keep the capital. So it seems like a very safe place to kind of just do what you're doing for the next few years. You have a lot of money in ETFs where you want it. You've got that 50 grand down. It's a small portion of your wealth in the grand scheme of things. And yeah, like once you start needing to make moves, it sounds like you might just want to sell it anyway because you don't want to go and pay off that darn loan. So you're going to get forced to sell it just under those circumstances. And then you can go figure out what you want to do, whether you want to go put down a larger loan somewhere else or whether you want to just rent for a while. So that's at least my initial take on it, is like, it doesn't feel as trapped to me as I think through it, because it actually just seems like a pretty low risk place to put capital.
Definitely. It doesn't feel trapped if I can refinance. I agree with that point of view. It feels trapped in the sense where I was sort of planning my options if I'm not able to refinance, and then how to navigate, whether it's using some of the ETF amounts or the savings over the next couple of years and not investing. That was the bit where, I felt a little bit stuck at times on how to go about it.
But if I'm understanding this right, you're only stuck if you intend to try and buy another property whilst you hold that, right?
Or rent as well.
Got it. Okay, sure. That's the part that escaped my mind before, right? So you do feel trapped there in the sense that you can't even, leave. You literally can't leave that place until that's sorted.
Yeah, I can't put my name anywhere. Yeah.
But I suppose, like when you do the math on that, it's only for like maybe the next 6 months, and that's only to avoid selling ETFs. So it's like a very short-term locked position.
Yeah, absolutely. I'd agree with that. If I can refinance, then that's if I can refinance. Then a sort of bit of short-term pain on not being able to invest. I'm always conscious, especially this year with the way the markets are, potentially missing out on some opportunities as well. I've got into a sort of a steady routine with investing, which I like. And like I said, the ETFs are sort of that main goal for me long-term, to be able to provide some more flexibility and cut some work hours as well, because my work's it varies a lot. And I think part of my FI journey is to actually free up some of that time, particularly when kids are there as well, and be able to have some more time at home and some more consistency with the work.
I was going to say, it's quite fascinating really, because when you get to the point where there is kids on the cards, then income in the household tends to go down, expenses in the household tends to go up, and then you also have a desire to work less, the partner that might be working more wants to work less to be at home to spend time with the kids as well. So it's this interesting dynamic where it's like, it's pretty suboptimal for finances, but it's like great for lifestyle, right? So you have all these competing desires at the same time because you tend to want to, because when you're in that position, you still want to be able to grow your ETFs, but you also want to be home at the same time. So you're kind of this push-pull between making more money and being able to invest, between being home and enjoying the lifestyle, like the family sort of situation. So it's this interesting dynamic that'll be at play there.
That's exactly what it is. That's where I was reluctant to have to sort of eat into the ETFs as well, because that's part of the plan there to try and free up a little bit of the time. But yeah, that is sort of where I'm battling.
Just on the ETFs too, like I've probably run into similar types of situations before. And, I think two things that have always helped me. One is like you can do a bit of mental accounting in terms of, from today, all your new ETFs are kind of part of your home fund in a way. And it becomes a lot more comfortable to kind of know that your portfolio you've built so far is protected and that this other stuff is earmarked for different usage. Obviously, in reality, it's just the same money, but sometimes that helps me kind of build up to it. If in like 6 months or a year, I do need to sell out stuff I've invested in because I'm like, that was always the plan. The other thing that's helpful too is sometimes when you need capital, markets are down and stuff. And I find that can nearly be, or sometimes you change what you want to invest in, which can help to some extent too. Like I've known some times where I've needed to get a pile of money for something. There's something I invested in that just happened to have gone up 10% and now it's back down 10%. And I'm like, well, it feels better to sell it out now because I don't feel like I'm missing out on the roller coaster. Or probably a more likely one is if I just kind of lose faith in something. Like I used to own a lot more kind of high yield ETFs or a lot more heavy on like the NASDAQ kind of, hardcore. And after a while of investing in that for a couple of years, it got to a point where I was like, I'm probably going to sell this stuff anyway and reinvest it. And it's like, well, most of the pain of that is dealing with the taxes of selling stuff. And at that point, if I've already got a property or something I want to deal with or your situation, it's like, it's not too bad. So I think there's at least some nice like flex with how you think about the nuance of that ETF portfolio as well.
Definitely. Yep.
Have you, you said before that you're very comfortable with the idea of renting even when you have kids. Have you spoken to your partner about that? And are they as on board as you are with that idea? Because it could be different between the spouses,
No, it's a good question. Yeah, she is. She is as comfortable. In terms of sort of her financial journey, that's where we're probably a little bit different. I'm probably more the saver and planner, and not that she's just an out and out spender, but we come now living together over the last few months from probably different financial backgrounds where it's just taken a bit of time to sort of align those goals. But that is one goal or one lifestyle situation that we're aligned on and we're comfortable with.
Yeah. No, that's really good to hear because it's interesting. I hear people often assume, I think a lot of singles tend to assume that all couples are like on the same page in regards to basically everything financial. So they think couples have this gigantic advantage all the time. But I find it's actually more common for couples to be different in terms of their psychology is what drives it, but in terms of their like financial goals and their motivations and their values around different things regarding saving and spending and lifestyle and things like that. So it's very, very common and very, very normal to have differing and sometimes even competing views and motivations at play. So it's just a matter of like meeting in the middle and finding a balance that both people are happy with and where you can get on the board, on the same page regarding certain things.
I'll just I'll butt in too and say I've been trying to say this to as many people as I can in the last 6 months, but the problems with renting I often think are mistaken for problems with being poor, if that makes sense. And I think like when people like I've had, the idea of renting, there's two things to it. And I'm not trying to convince you, Steve, this is more for our listeners, but, people often say things like, oh, if I own something, I can do whatever I want to the place. And it's like, all I've ever seen is if you're renting, you're asking a landlord. If you're owning an apartment, you're asking strata. If you're owning a house, you're asking council. There's like always, it's a bit of a false economy, the idea of like how much you can change. There's obviously a little bit more each time for sure, but there's always still hurdles to get through. The other part that I think people miss on renting is the fact that the biggest headaches like moving can often be solved with a little bit of money. Like if you're kind of, wealthy enough to own an apartment and you have a couple $100,000 in ETFs, so let's say you have $300,000 or $400,000, the cost of actually moving house or even paying someone to come and just pack up your stuff and carry it for you might often only be like in the $3,000 or $4,000. And that's the kind of money people piss away in interest rates because they didn't refinance or something, like it's kind of like low capital problems. And I think they're two really good selling points if you ever need to sell anyone in your life around the renting part.
I would add another one to that point too, where having more money as a renter is a completely different experience than if you're just a regular renter with very little money, is where you might be trying to find a new property and you're in a hot market and there's very few rentals around and you need to make your application more appealing than someone else's application. Well, you can afford to pay 6 months rent in advance when most people couldn't afford to do that. So if you can offer to do something like that and make that part of your application, it might only cost you like, what's that, $15,000 or something like that. If you're paying $30,000 a year rent, that's going to make your application look so much more appealing than someone else's. So just little things like that can make a big difference as well.
Yeah, a lot of these things that you talk about, and that's why I really enjoy this podcast, because I'm part of the FIRE community. I guess like I listen to a lot of the podcasts and I love the move, but at the same time, I'm not going to sacrifice sort of that comfort or push myself to the limits where it affects too much of the convenience or the comfort factor as well. So that's always been a big factor for me. And even, looking to rent vest, it might not be the absolute prime financial decision to make, and I could save some dollars elsewhere. But for us, it's a big thing on the lifestyle. And that's in a couple of factors of our life. Like you mentioned the travel, that's a really key part of our lifestyle and factoring in what we want to do. And even this property here, I juggled weighing up where I wanted to buy. And for me, it was buying in a location that I loved, where the lifestyle fit in around work and our lives together, compared to potentially going out and buying a 2 or 3 bedroom property that was a while away. So for me, it's balancing the convenience and comfort still with making good financial decisions as well.
Yeah, I think that's a really intelligent thing to do, because you've chosen something that works for the lifestyle you want while also keeping the cost from exploding out of control. Because if you add a second and third bedroom, or a bit nicer and a bit bigger in the same place, the cost starts to blow out like tremendously, like tens of thousands per year extra. So I think that makes a lot of sense. And in regards to like the long-term plans, being open to the idea of being a rent investor as you go and approach properties that are higher in the price scale, renting is going to be more affordable. It's going to be increasingly more affordable than buying the same place. So I don't know if you've looked at, everyone kind of does. You probably looked at places that you would like to live in the future.
Yeah, I always have a cheeky look.
Yeah. And so if you compare like the rental prices, which they might still be high, but if you compare that to all of the costs of owning the same property, it's probably going to be significantly different, like tens of thousands again.
Yep.
So that's going to be cash that you're going to be able to invest rather than having to pay, interest and rates and whatever other costs that are going to come with that property. So yeah, having that open mind and flexible strategy around whether you buy or own while still being in the market too, because that's one of the concerns that people have is, well, if I'm renting, then I'm potentially missing out. But you're still going to be getting benefits of the property market, and people might say, but it's a unit. Units won't grow as much as houses, and they probably won't, but it's not going to have no growth. Units are still going to grow over the long term. So you're not going to like fully miss out in that sort of sense. And you're also going to be investing aggressively on the side, which you're already doing. So your wealth is going to be growing at a fairly impressive rate, even if you're not like getting maximum property growth, let's say, by owning an expensive home.
Yeah, that's the peace of mind factor that I have still having this unit. Like you said, it'll go up a little bit. Property's not part of my financial independence plan necessarily, but in saying that, it'll have to be something that I sort of factor in what I'm going to do well down the track, sort of 10 plus years away, because ultimately I would like to still be able to buy a bigger property that we sort of, whether we retire into it or our kids, grow up in. That's still a factor for me, and navigating how we go about that. And even whether my partner uses a similar scheme as to what I did as well, where she could get the same government incentives, given she would be a first home buyer as well.
Yeah, it's a good thing to keep in your pocket for sure.
Yeah, that's the bit where I'm sort of juggling what that step looks like as well, whether it's I sell this current property and we look to buy together and we get that bigger property that we can spend plenty of time in. Or
What's the limit? What's the price limit of the places you can buy?
so when I purchased, it was capped at 600,000, and there was also a certain amount per year that could use the scheme. Now my understanding is it's now unlimited places, and it's gone up to something like 800 or 850,000 in Melbourne.
Yeah, cool.
So there's some more opportunities there that I guess we weigh up as well, which we've briefly discussed, but that's something down the track.
So they increased the price limit dramatically, even though prices haven't really increased in Melbourne. That's pretty generous.
Yeah. It was quite a big jump because we've had a few friends that are sort of around that mark, and a couple have decided to just either buy the property based on that or sort of they wanted to get that bigger property or more expensive property and sacrifice some of those incentives.
It's pretty cool flexibility because as far as I understand it, that also means that as long as you guys are living separately, she could buy a place, and have a slight overlap if you wanted to, sell your place another month after or something, because those two are independent stuff. It's just whether you'd want to carry that cost, right?
Yeah, correct.
Yeah, cool.
Or you could have one home and one holiday home, mate.
Yeah, I mean, then we're just getting spoiled for choice. But yeah, it's endless.
That might blow out the fire goals a bit, trying to have two homes.
I was going to say, I said I like comfort, but I still got to keep it in balance.
Moderation, hey, moderation.
Yeah. I actually had different options as to how I was going to approach basically paying off this VHF amount. But yeah, I mean, the refinancing part makes sense if I just sort of wait out that next period and can use some of the savings.
Yeah, I think because from memory, you gave us 3 options, and one of them was paying down the loan basically like fairly aggressively in the next few years, and the other one was selling the property, which it sounds like that's definitely not ideal because you really like the property and it's not an expensive property to stay in, so you're not really sacrificing too much in terms of income, and it also keeps you in the market at the same time. Or the other one was kind of dragging it out from memory, right?
It was basically doing like a hybrid where you're just lengthening everything, but that clashes with sort of the plan to have kids and that short-term goal. Yeah,
I'd look at refinancing like as soon as feasibly possible, because it might be sooner than you think, and if that doesn't work, then probably I guess you want to slowly pay it down as much as you need to, I guess, to work with your time frame of potentially moving out in 3 years and going and renting somewhere and then turning that one into a rental.
Yeah, and I mean, that's the other benefit on sort of why I purchased this as well, is I did buy it with rent vesting in mind still, knowing that this wasn't going to be a property I could live sort of more than 10 years in, and I was going to grow out of it, but it rents out really well. It was being rented before I purchased for actually, I think, pretty much the amount the mortgage is.
Yeah, that's cool. I was just going to say, how have you found the experience of living in a 1-bedroom apartment? Because I've got a friend who, it's interesting, he's not really like in the fire community, but he kind of does similar things where he lives a fairly simple lifestyle. He bought a property that was much smaller than he could afford. I think it was a 2-bedroom apartment. And people are like, why don't you buy a 3-4 bedroom new house? Because you could afford it. Because he's in Perth and it wasn't that expensive at the time. He's like, but I only need like something small. So why would I do that? And then he's been able to save and invest on the side. And his friends that went and bought like big houses, they ended up kind of, I think their incomes kind of struggled a little bit after that. And then it became very expensive as interest rates went up and all the rest of it. And now they're looking at him like, oh, that wasn't such a bad idea after all to buy something a bit smaller, So,
100%. I can relate to that a lot. And that was always part of the plan there. I value the flexibility the most. And I mean, my lifestyle is pretty simple. And my work hours, they're pretty long and it varies a lot. So it's almost like I've got a base here rather than spending a lot of time at home. I'm busy. I like being outdoors. I like being out a lot. So for me, it's worked really well. I've always been conscious that with my partner coming in, that's a different factor, and we're sort of going to outgrow that to an extent. So yeah, it's worked perfectly the last couple of years for me here myself.
Yeah, I think that's all very interesting, Steve. And I really love the way you think about it all too. Like, it's clear you've really thought about the scenarios, and it's really refreshing talking to someone who's so engaged with their finances, because it's not always the case. I did have one question for you just before we wrap up. What's like the biggest lesson you feel like you might have learned, or at least one of the bigger lessons in the last couple of years, going through all these journeys and processes that, you think some of our listeners might, find insightful?
I would say to not underestimate how important and valuable the flexibility is with your finances. That's always been at the forefront of my plans and my goals with money, and purchasing sort of within my means and being able to navigate life, being a little bit more flexible, and I think it's just helped being not feeling sort of stretched too much and like I'm sort of sinking a little bit with my finances. I think that's helped.
And you mean flexibility in terms of like your household cash flow, let's say, in terms of not pinning yourself into a corner with this massive expensive lifestyle and this big mortgage to pay for. So you've got more choice over where your money goes and what to do with it based on that.
Correct. Yeah, I think there's such value in that, and it gets maybe underestimated at times while we're just trying to max everything, and that's maxing where you're living and your housing costs and pushing sort of too much at times. I think the flexibility's been something that I've always valued, but I really realised that how important it is, particularly when you've got a partner involved. You value your lifestyle a lot. It's helped a lot.
Yeah, for sure, absolutely.
I was just going to say that's one thing that's always been super important to me, because if you don't, like, the opposite side of that spectrum is where you feel restricted and you feel entrapped in like some sort of self-imposed slavery because you're trying to, max out your lifestyle, but you've really minimized your freedom at the same time. So it's this weird conundrum that people get into. They think they're gaining something, but they've forgotten what they're losing in the process.
Absolutely. I've got friends who, on the sort of face value, they're on fantastic wages. They've got great jobs, great houses. I've got a lot of friends who have purchased like me in the last couple of years, but in their own words, feel very restricted and sort of stuck in their situations. And what ends up being sacrificed is that lifestyle and enjoyment of life. And especially whilst I'm young, that's really important for me as well.
Yeah, that's an incredible message. I hope people listening can really take that away for all the awesomeness. And it's been the experience of Dave and I, as Dave said too. The amount of stress-free life it brings you, the amount of control, probably makes you live longer too. But, on behalf of Dave and I and the listeners, just a big thank you for taking the time to come chat to us, Steve. It's hard to tell when it's just the three of us in a call, but there's hundreds, if not thousands of people who really appreciate you taking the time to share today.
No, it's been a pleasure. Thank you, Hayden and Dave. I've been really looking forward to doing this, so thank you for making the time.
Yeah, more than our pleasure to have you here. For those listening, if you would like to share your own story, join us on the podcast. We're bringing guests on, basically jump on a call with them and chat about their circumstances. You can reach out. You can follow the links in the show notes. We have a link there for any questions people want to ask, and we have a link there for something like this, which is where you want to join us on the podcast. But if it's not one of those two things and you'd like to reach out to us, you can email us at hello@aussiefirepod.com, or alternatively, you can reach out to us on socials. You can reach out to Dave at Strong Money Australia or myself at Perla. But otherwise, thank you all for listening today, and we'll catch you in the next episode.
Thanks, guys. And thanks for joining us, Steve. Appreciate it, man.
Thank you so much.
We hope you enjoyed this episode of Aussie Fire. For more FI inspiration, head to Perla.com to browse our resources, calculators, and community insights. Perla is an authorized representative number 1281540 of Sandland Private Wealth Pty Ltd with AFSL number 337927. Knowledge is power, especially when investing. So always seek advice and/or check out the relevant disclosure document for any financial product, including the PDS and TMD before deciding. These are available from the product issuer's website. When you invest, your capital is at risk, and past performance is not a reliable indicator of future investment returns.